When most people think of bubbles, they think of spherical bubbles floating in soapy liquids. A stock market bubble, on the other hand, has a quite different meaning. Stock market bubble is usually caused by economic and market reasons that produce illogical price swings in assets. A stock market bubble can emerge when the market is overpriced and investors continue to pour money into the market. Here is Kathy Wood's asset bubble is collapsing. This is her Stark portfolio now. But before that, don't forget to click the subscribe button to stay updated with all our engaging videos, and use that trigger finger by smashing that like button. Now let's get into it.
To thank you for watching this video, we're offering you an absolutely free training webinar. Have you ever wondered how to end procrastination and self-sabotage so you can unleash your full potential to live the life you deserve? #1 best-selling author and high-performance coach Peter Sage is hosting a free webinar where he'll teach you how to increase your wealth with less time and struggle, and also how to hyper-boost your growth and success so you can finally break out of any rut you find yourself in. Right now, Peter and his team are offering a free $100 gift to anyone who doesn't find his webinar as the best use of their time within the last 5 years. Now, let's get back to the video.
Bubble in the stock market. When it comes to the stock market, commerce, or economics, the word bubble is usually the last thing on anyone's mind. Traders and investors are afraid of the phrase bubble since it has potential to damage riches and perhaps cause a market disaster. When investors drive stock prices to the moon and assets become grossly overpriced, a stock market bubble can occur. This circumstance has the potential to attract a large number of new investors, as all they perceive are the high and appealing profits. When the bubble bursts, however, the value of every investment plummets, resulting in massive wealth destruction and losses. In general, the term bubble is used in the stock market to describe situations in which the price of a particular commodity rises above its true value. This could be due to an increase in demand for a specific commodity, stock, or asset over a period of time. When this demand reaches a point where it no longer appears sensible, it begins to decline depending on its market worth. When a bubble explodes, it is commonly referred to as a bubble burst. When interest rates skyrocket and asset prices reach their peak, bubbles usually bust. Because stock market bubbles are uncommon, they tend to follow a specific pattern. These trends include an initial stage in which prices begin to decline slow, luring investors, and soon after the momentum builds, prices rise swiftly at a very high rate, resulting in market instability and a crash. Then a few manipulations start to take place, leading to a regular known as the bubble burst. Some investors take advantage of these movements on a regular basis when the price of goods in the stock market are manipulated for above their true value due to stock valuation techniques. A stock market bubble occurs. Stock market gurus could easily forecast these bubbles. These bubbles are commonly seen to be rational and infectious. When a certain item becomes popular in the stock market, a bubble forms. People are curious about how it functions and how they may profit from it. As a result, more people invest in it, and the asset eventually becomes overvalued, producing a scenario in which the asset's price rises as a result of the hype surrounding it. You don't want to miss this, so stay watching. How can you identify if the market is overvalued and in a bubble? It's possible for the stock market to be overpriced or undervalued. When the demand for a specific asset rises rapidly, it forms a bubble and becomes overpriced quickly. When investors buy these in-demand goods, they usually do so with the expectation of selling them at a profit. The market tends to become overvalued when this happens. In other circumstances, however, this no longer occurs and expectations are not satisfied. It could be the outcome of a shift in market sentiment. As a result, traders and investors sell their investments below their expected target price since they are afraid of losing money. The market is thought to be undervalued at this time. However, determining whether a market is in a bubble or is simply overvalued is difficult. It is vital to be able to recognize when a market is overvalued or in a bubble in order to have an advantage over other investors in the market. Once the scenario has been discovered, investors must take action as soon as possible to avoid losing money. You can identify an overvalued stock market through the following means. #1, market capitalization to GDP. Market capitalization is calculated at about the same pace as the GDP ratio, and it's often regarded as a powerful indicator for detecting an overvalued market. The general market ratio can be easily detected because it is not very frequently in the market. When the ratio falls below 0.7, it's said to be undervalued, and when it increases above 1.25, it's said to be overvalued. When the market is undervalued, investors tend to buy more. In other words, the stock market is overpriced when market players are prepared to pour money into it, regardless of asset values or actual valuation. The only method for investors to profit from this situation is to trade short bets. Because short positions are inverse in nature, they might profit when asset price decreases. #2, calculating the general market ratio. The general market ratio is calculated in the same way as individual stock ratios are calculated. The general market ratio is easier to find because it is generally estimated by market specialists and the data is readily available. When the price-to-earning ratio is determined using historical data, the average earn is commonly referred to as the normal price-to-earning ratio. As a result, the price-earnings ratio is known to be overvalued when the current data calculated is more than that provided in the past. The Great Depression of 2008 provided an example of this.
To thank you for watching this video, we're offering you an absolutely free training webinar. How would you feel knowing that you could pay every bill you have right now as well as any future bills that come in? Commission Hero is a proven system that has helped over 8,000 people earn upwards of $1,000 a day or more. The best part is that there is zero experience needed to get started. In this free training, Robbie Blanchard and his team will teach you the top 3 secrets to how and why this system works, and how it can also work for you. Join the thousands of people who have found success and financial freedom using Commission Hero. Right now, the first 100 people that use the link below will get access to this free webinar. Now let's get back to the video.
Steps to identify a bubble in the market. There are various approaches for investors and traders to spot stock market bubbles. It's critical to recognize these bubbles in order to determine when to invest and when to exit them. The steps below can assist you in identifying a market bubble. When asset values rise abnormally, a bubble is most likely to form when it's in a dramatic increase in price over a few months that should most likely occur within years. As a result, when the bubble collapses, a loss and destruction of wealth occurs quickly, and volatility skyrockets. When there's an availability of low-cost credit, this happens in late-stage bubbles. This, on the other hand, increases the danger of risk since more people are burrowing in to invest, increasing their overall debt. Most people assume that identifying a bubble until it breaks is difficult. This may be true since not all activities that create an increase in demand for an asset will result in a decrease in its price. If you can spot a bubble early on, you might be able to predict whether it will result in a drop in asset prices. Stages of a bubble. Identifying the various stages of a bubble is critical because it allows you to change and rebalance your investments as needed. With a little diligent analysis and research, these stages can be easily discovered. The early stage is simple to recognize since it coincides with a substantial increase in asset prices, unlike the late stage, which occurs over a longer period of time. This early stage occurs in a short amount of time. When opposed to spotting a bubble in its ultimate stage, identifying a bubble in its first stage is easier. In the early stages of a bubble, fresh investments and investors are attracted, and new market opportunities are frequently created. More market expansions and job possibilities result as a result of this. The late stage of a bubble is a corrective stage that serves to clean away the surplus investments that saturate the market and slow it down. These 2 stages lead to a number of other stages that are referred to as the various elements of a market bubble. These stages are distinguished by comparable traits, despite the fact that they are distinct. How to avoid getting trapped in a bubble. You should avoid getting trapped in a bubble and losing all of your hard-earned money at all costs. However, detecting a bubble at an early or late stage is insufficient. To minimize wealth destruction and losses, you must protect your investments from these bubbles as an investor. You must avoid unreasonable excitement in order to achieve this. Avoid purchasing things solely because they appear to be worth a lot of money. This is because, in most cases, prices will tend to rise over an extended length of time, making it difficult to detect a bubble about to burst. Diversification is an effective way to avoid becoming engulfed in a bubble. You balance or allocate all of your assets here on a regular basis. You might also do this by learning how the economy and stock market work and keeping an eye out for price spikes that lack a solid foundation or justification. Market bubbles are sometimes known as asset bubbles or speculative bubbles. These bubbles can occur in a wide range of assets and are typically the outcome of excessive speculation and greed on the part of market players. This frequently results in irrational exuberance, indicating a collective excitement among investors and traders. However, as an investor, you should avoid following the crowd and thoroughly scrutinize every investment to guarantee you're not making foolish selections. Did this video help you understand the asset bubble? Let us know in the comment section below, and if you've enjoyed this video, don't forget to like and subscribe to our channel for more amazing content. Thanks for watching. See you again in the next video.